Andrew, thanks for being with us. Given non-OPEC production struggles, shale gas, et cetera, what are your current views on crude oil for the market for 2010?
Well, first off, thank you, Heather, for being here. It's my pleasure. I think looking into 2010, our commodity price forecast for oil is for $75 a barrel. Oil has remained much firmer than natural gas over the last 12 months, and the forward curve is still holding up that strength. So we're optimistic that as the economy kind of regains some footing, that oil prices will remain firm.
That's a little bit under Iran's forecast of $100 a barrel.
Certainly. I mean, there are folks out there who think that the political risk component could always come back into play in a much larger fashion, but we tend to be a little more traditional and think, let's think on supply and demand, and ultimately I think it comes down to global growth.
What were the growth rates in the fourth quarter and last year?
On the oil side, we're starting to get numbers right now with earnings coming out. Most of the companies that I cover will be reporting really in 2 weeks. Overall, the initial data points have been, excuse me, on the smaller mid-cap side, that we've had a little bit of production declines, really reflecting a year of reduced capital spending and lower rig counts.
So are producers hedging going into 2010, 11, and what does that mean for the gas bulls?
Yes, producers generally hedge to protect cash flows, and as we look at 2010 with a higher oil and gas futures curve, the additional hedging that my companies have added in have largely been to protect 2010 activity, which again, following on 2009 where activity was very low, that provides an opportunity to develop more production growth.
Now, its CapEx budgets, are they growing, and is that going to continue throughout the year?
Yes, CapEx so far has been up, I think, around 10 to 15% across my companies. And I think really coming out of winter, in my mind, the risk is that if gas prices, and 70% of my companies produce on average 70% natural gas, if gas prices soften from the kind of $5.50 to $6 level that they're currently at, then we could see softening in CapEx. Otherwise, I would expect, because of the hedging, because of the forward curve, that we'll see kind of the current spending plans kind of sustain through the year.
So even oil opponents are saying we're going to have to start drilling in the U.S. So what does that mean for domestic oil companies?
Well, I mean, there's certainly a lot of oil potential in the U.S. The question is, what time frame will it take to get the oil to market? I mean, it's certainly a very complex question. From my standpoint, we've seen discoveries in parts of the Gulf of Mexico that have piqued a lot of interest here in the last month. That plus the addition of shale gas over the last couple of years, provides an interesting opportunity for us to increase our indigenous oil and gas supplies.
So there was a new accounting standard that I believe was applied to your companies this last quarter or this last year. What is that, and how does it affect your companies, or how you look at them?
Sure, it really has to do with how oil and gas reserves are priced. Historically, the old rule was that you would use the price in effect on December 31st, and companies were concerned, in prior years, that if you had a lot of volatility, that the December 31st price did not reflect real kind of sustainable kind of activity. And so the SEC moved last year to go to a essentially average price for the year. And so this will be the first year that we see those prices roll through the reserve reports.
Given recent acquisitions in the space, Exxon, XTO, do you see that continuing, or is it more of joint ventures, or is it outright sales?
I mean, in the oil and gas space, there's always a healthy amount of property divestitures and acquisitions, and across with most of my companies being kind of under $5 billion in market cap, that they tend to be more active than the larger players. If you look at 1998 and 2004, big M&A waves, those kicked off in the summertime in 1998 with, I think, BP buying Amoco and Exxon buying Mobil, as well as in 2004 with some of the smaller mid-cap guys kind of consolidating. If that suggests that maybe heading into the spring, if commodity prices soften again, that we could see additional M&A activity.
Great, thank you, Andrew.
Thank you.